Microsoft drops. Tesla drops. People scream. The AI bubble is popping. Charlie Munger would probably smile and say, "Calm down." After earnings, Microsoft and Tesla sold off. The story? Too much AI spending, too much infrastructure, too much hype. Data centers are expensive. Chips are expensive. Electricity is expensive. Markets don't like expensive surprises. Today, let's calmly talk about what to buy, what to avoid, and what to do when you're already holding at high prices. After recent earnings, Microsoft fell, Tesla fell, and suddenly, people declared the AI bubble was bursting. The reason given was simple. AI infrastructure is incredibly expensive. And markets don't like seeing rising costs without immediate, crystal-clear profits. This isn't a new story, but the scale is different. Charlie Munger often said, "It's not supposed to be easy." Anyone who finds it easy is stupid. Volatility in the stock market doesn't mean something is fundamentally broken. More often, it simply means that expectations were too high and reality is setting in. The recent drop in AI-related stocks isn't a sign of the technology's failure. It's a sign that the market's enthusiasm got ahead of itself. It's a classic Munger lesson. The market is a pendulum that swings from irrational exuberance to unjustified pessimism. Our job isn't to predict the swing, but to act rationally at the extremes. So, what would Munger likely avoid buying right now? He would avoid businesses that need everything to go perfectly right just to survive. First on that list are unprofitable companies that exist purely on an AI story. Think of companies like C3.ai, SoundHound AI, or Big Bear. AI, these companies might have interesting technology, but their survival depends on capital markets staying generous and open. Munger deeply disliked dependency. He wanted businesses that controlled their own destiny, not ones that had to constantly ask others for money. When the cost of capital goes up, these are the first businesses to feel the pain. Second, he'd be cautious of capital-intensive businesses with unclear returns, even large, well-known firms. Take Tesla, for example. If its profit margins continue to get squeezed while it spends billions on new factories and AI projects, that's a red flag. The same applies to semiconductor or cloud companies where capital expenditures are rising much faster than their earnings. Let's be clear, massive spending is not the problem. Spending without a visible and probable payoff is the problem. It becomes a gamble, and Munger was an investor, not a gambler. And third, Munger would tell you to run from stocks bought purely on momentum. If the only reason you own a stock is because it was going up, he would say, you are already in trouble. That's not an investment thesis, it's speculation. Momentum is a powerful force, but it works in both directions. When it reverses, those who bought only for the upward trend are left holding the bag with no fundamental reason to stay. So, if we're avoiding the hype, what should we be looking to buy, or perhaps accumulate slowly during this downturn? Munger consistently favored businesses that could survive disappointment and come out stronger. First are the cash-rich, dominant franchises, companies like Apple, Alphabet, and even Microsoft at more rational prices. These giants can afford to invest heavily in AI without betting the entire company on it. They have rivers of cash flow from their core businesses, which allows them to experiment, to fail, and to ultimately win in the long run without putting their existence at risk. Their balance sheets are fortresses, not sandcastles. Second, Munger loved boring businesses with durable pricing power. Think of companies like Costco, Johnson & Johnson, or Procter & Gamble. These are the businesses that sell things people need regardless of the economic climate. They have the ability to raise their prices quietly and steadily over time, and their customers keep paying because the value is there. Their strength isn't in exciting new technology, but in the simple, repeatable act of earning a profit year after year. This quiet compounding is where true wealth is often built. And third, he always prioritized financial strength over excitement. Munger preferred balance sheets that let management sleep well at night. This points us toward companies like his own, Berkshire Hathaway, or other high-quality insurers, utility companies, and providers of essential services. These are not the companies that will double in a month, but they are also not the ones that will collapse when the market gets nervous. They are built for endurance, not for a sprint. Now, let us address the most difficult situation. What if you were already holding some of these high-flying stocks that you bought near the top? It's a painful spot to be in, but panic is your worst enemy. Here is a rational, step-by-step plan. First, you must ask yourself the hardest question. Did I buy a business or did I buy a story? Look at the facts, not the stock price. Are the company's revenues stable or growing? Is its cash flow real and positive? Is its balance sheet strong? If the fundamental business is intact, then price volatility alone is not a valid reason to sell. Great businesses often experience temporary price declines. Step 2. If a position is causing you constant anxiety, it is too large for you, regardless of the quality of the company. Your emotional stability is a crucial part of your risk management strategy. It's perfectly rational to trim a position gradually. Not because the company is bad, but to reduce your own stress so you can think clearly. You don't have to sell it all, but selling just enough to regain your peace of mind is a smart move. Step 3 is to admit mistakes early when necessary. If you look honestly at your investment and realize the thesis was pure hype and hope, then selling is not failure. It is a necessary course correction. Munger greatly admired people who could change their minds quickly when the facts changed. The market doesn't care about your ego. Cutting a loser to redeploy capital into a better idea is one of the hallmarks of a great investor. And finally, step 4. If the business remains strong and your thesis is intact, the best course of action is often to wait. As Munger famously said, the big money is not made in the buying and the selling, but in the waiting. Inactivity, when correctly applied to a portfolio of wonderful businesses, is a superpower. So, to summarize our strategy for this market, avoid the fragile, capital-hungry stories. Favor businesses with real cash flow and strong balance sheets. Buy slowly, never emotionally. And treat your cash reserve as a tool for patience, not a symptom of fear. This is not a market for blind excitement. It is a market that calls for discipline. Every generation of investors believes its moment of uncertainty is special and unprecedented. It never is. Markets have always been, and will always be, volatile. In the long run, they consistently reward people who avoid obvious mistakes, remain calm when others are panicking, and wait patiently for sensible opportunities to present themselves. No predictions, just judgment. Thanks for watching.